Hello and welcome back. Today I wanted to take some time to discuss how I look at different investments and my strategy for going through them and the research process, and how I think about different investment opportunities. So, the first thing I do always is I try to ask myself, I look at my existing portfolio. I say, one, how much cash do I have? Um, and two, is there anything I want to sell out of currently? So I try to look at what my existing holdings are, how they're doing, and how much cash I have. So am I too invested in cash? Have I gained too much? This last year, if a stock has done extraordinarily well for me lately, I'll potentially take some gains. They say you never get, no one ever went broke taking profits, which is true. And so there are times where I will sell something if I either don't have enough cash or if I want to improve more cash. So that's the first thing. I always try to look at my cash balance. And because if you have no cash, you really can't do any investing. So I try to say, do I have some stuff and what do I want to do with that cash? Sometimes I want to just sit tight. If not, sometimes I go to the next step, which is, again, looking at the portfolio and I try to say, um, what are there either, I want to say, do I want to look at existing opportunities or new opportunities? So by existing opportunities, I mean things I'm already invested in. I already have a ton of Tesla. Do I want to add more to Tesla? Probably not. I actually am trying to reduce the percentage of my portfolio that's Tesla. I don't want to sell any because I still believe in it, but I don't want to invest more. Now, if it dropped enough, maybe I would, but currently I say, you know what, I'm over invested in Tesla. Let's try and find other opportunities. Could that be Amazon? Could that be Facebook? Could that be Google? And because I invest in these companies, I've already done a ton of research. I kind of know um, where I want to buy in. So, I say, hey, I've already done a ton of research on Facebook, and I know I like it under 300, let's say. Now, obviously, if something's changed, if it's been a year where there were recently earnings, I'll obviously update my priors. But if it's been 3 weeks and the stock's down 20%, I say, oh, you know what? It's getting back into the attractive spot where I want to buy. Then I might look to buy that. Again, I try to say, is an existing opportunity in an attractive, um, is it an attractive price? And am I overinvested in it? So again, don't want to add more in Tesla unless it gets super attractive. But others, if they're a little attractive, I'll probably nibble and I'll try and dip my toes in if I think it's below where I actually want. Now, typically, I've set my prices. I know what I am, and I look and I say, you know what? I already have a pretty well diversified portfolio, so I don't want to buy any of the companies I already hold. That's most days. And when that's the case, then you say, okay, let's look at new opportunities. Maybe there's a new company out there that's undervalued. So I first always start with stock screeners. So stock screener is a basic way of trying to take the world of stocks. Again, there's thousands of stocks out there and divide them up so you have a smaller list. So I say, okay, let's look at companies that are, you could say, you got to ask what your criteria is. Maybe you say, I only want to look at companies under 50 billion that are rare, like that have a PE under 30 and had revenue growth last year. I'm making that up as the criteria, but you could do that. And there are sites that allow you to add those filters. My personal filters are I typically try to look at revenue growth. I try to look at a multiple of price to gross profit. And the reason I use gross profit and not earnings is because I'm often looking at tech companies. And with tech companies, sometimes they can have almost no earnings or even negative earnings. So a PE ratio is useless. You can also look at price to sales, but price to sales is very different for very different industries. I also typically, when I'm doing this, I typically filter out certain industries. So if I'm looking at financials, I use different metrics than if I'm looking at tech companies. So I'll typically, if I'm using my price to gross profit, I typically factor out real estate companies, REITs, financial companies, commodity companies. So that might be oil, gas, precious metals. So I try to filter all those out. So I try to take comparable companies. So that's one, know your industry. So again, I look at the industry. So if I'm looking at tech or consumer goods, I use different metrics based on this. So again, typically for tech, I look at or, price to next year's gross profit. And again, the reason is because every company is going to have positive gross profit, or they should. If they're not, they don't really have a very good business. Um, but they might not have earnings because they might be spending a ton to grow right now. So what's price to next year's gross profit? And then I also look at revenue growth, and I look at kind of a multiple of that. There's something called a PEG ratio, which is price earnings to growth ratio. I basically do that, but instead of price to earnings, it's price to gross profit. So I use that to say what is looking cheap on next year's gross profit rate. So, if this company is 7 times next year's gross profit, but growing 50%, that sounds pretty freaking attractive to me. So I filter out these companies, and now I'm left with maybe a list of 40 or 50 companies. So these, or maybe even less, depends on if I'm looking at all industries minus those ones, or if I'm really focused on just tech or just consumer electronics or manufacturing or whatever it is. And again, each one is going to have its own filters. Once I have these 20 to 50 companies, I then do a little more digging. So I do a little more research. So one, are any of the companies there, do I know them? That's the first thing. Because if I already know the company, it's a lot easier to do research. So, oh, look, there's eBay. I know eBay. I can more readily understand the business model, because again, this is where I get to my three-pronged approach. I always do this for some reason. So I look at one, do I understand the product and business? If I don't understand the product and business, I'm probably not going to invest. I really want to understand why this company is going to grow. Who are its competitors? Why is it going to beat out the competitors? So I don't really invest in biotech companies because I really don't understand the science behind them. Would I? If something looked attractive enough and I understood the thesis, I think I'd be more interested in like a medical device company, because that I can kind of understand. But the actual nuts and bolts of, oh, this is going to treat cancer in this way, like that's way over my head. So again, I try to understand the product. Do I understand the product? Do I understand the market? Do I understand its competitors? Do I understand the thesis? Have I used the product? These are all big elements I look at. So first thing, look at the 50 companies. Maybe I'll know 5 of them. That doesn't mean I only look at those 5. I'll typically then Google them all, try and say which of them do I actually understand. Some of them seem way over my head. I don't understand this, and so I just ignore them. That's okay. You don't have to look at every company. Again, there are thousands of companies out there. You want to put your chips in where you're most comfortable and confident. So, we have 5 that I know, and maybe I learn about another 5 to 10. So now we got 15 companies. So this is a much more manageable number. So now that you've got these 5 to 15 companies, or sorry, these 15 to 20 companies, let's say, um, then we start looking at kind of the macro environment. So again, then I kind of try and say, okay, which of these companies do I think, not just do I know and do I kind of understand, but have I heard good things about it? Do I really understand that they seem to be winning? You can look at that from revenue growth. You can look at that from, you know, Twitter positive reviews, Google Trends, which I use a lot to see like how people are searching for different things. Are they searching for this service or that service? Are people, I'll just as an example, are people using Snapchat more? Or are they using Instagram stories? And how is that trending? So again, you want to see, I still focus on the product. So from there, I probably can knock out another 5 companies, which just seem to be like, okay, I know I can understand the product, but they don't seem to be good products or growing products. And, maybe they grew last year just because of a COVID bump and it wasn't a lot. So now that I have 15 companies, then I start looking at the financials. And also in that stage, not just am I looking at product, I'm also looking at the second one, which is the macro environment. So again, is this something that is going to benefit from the world we're living in? If this is people are getting older, so is this an old age home? Oh, you know what, that could grow because as people get old, they need more assistance. Or is this something that I think is fighting against current trends? Oh, look, this is an oil and gas company. Again, I don't invest in any oil and gas company, but I'm like, I think that's the opposite way the world's going. And so there are companies where I sometimes say, yeah, I understand the product and it is growing, but like, I just think you're fighting an uphill battle because the trends are going the other way. If there was a real estate brokerage and it was doing really well, I still think people are going, real estate brokerages are changing. And I have a thesis around the real estate industry. And so I would want if I was investing in a real estate company, I'd want that company, even if I understood it well, to be following the trend that I see, um, which is everything's going more online and more automated, which is why I'm a big believer in Redfin and Zillow. Um, Full disclosure, I own those. Okay, so now we've narrowed from 20 to 10. So now we got 10 companies, five knocked out because I don't think they have good products, five knocked out because I don't think they are in the same macro strategic vision and direction. Okay, now we look at the financials. And this is just lots of work. Now you can do a rough thing, and there's sites out there that will do rough DCFs. There's Finbox, which I really like. You can do tip ranks to see what analysts think of it. You can do a lot of these things. And I do all those, but I also want to dive into the numbers and do my own numbers, because I need to make my own. Um, I say never borrow someone else's opinion. Always use your own thoughts and opinions of the company to dictate whether you buy or sell. So, I looked at eBay. I didn't end up buying because I thought it was overvalued. But some of them said, "Oh, look, this is an undervalued company," and sometimes it said, "Oh, this is fairly priced." I like the optionality that they were getting to NFTs and these collectibles, and I do think there's still some value in the eBay name, but I just was not convinced by the numbers. If it was 20% lower, I'd probably have bought. But just at the price it was, I said, there's too many uncertainties. I know the product, but I'm not like intimately familiar with it. I've used it a couple times recently and was not impressed. And so, if it's a great value, I'll do it. But like if it was just a so-so value, so I passed. Um, there was another company like that, which actually I regret. It was Williams Sonoma, which I also thought looked really. I understand the product. I understand the, like what they're doing. I think it's strategically aligned. I think people are going to spend more and more money on their homes, and yet I think at the time it was like 200, and I was saying, oh, you know what? I think the price is in my mind, it was more like I'd buy in at like 165. And it had been 165. It actually ran up very quickly. I think it was like late August, mid-August maybe, and it was like 160, and then like a week later it was 187. So, and I liked it, but I didn't pull the trigger. So sometimes you got to make, at the end of the day, it's all a judgment call. You can't just listen to the numbers, but you have to let the numbers dictate. And I said, you know what? It's a good company, but it's not, you know, it wasn't what I wanted. Again, you also want to look at it within the broader portfolio. Do you want 7 EV makers? Probably not, because they're all going to be correlated. If the government says, oh, we're cutting tax credits for EVs, they're all going to drop. So I like having a well-rounded company. So I look at, again, there's the individual, and then there's how it fits in within the portfolio, and that's a different skill. And maybe I'll make a future video on that, portfolio management, because that's a very tough skill to have. Even if you can analyze a company, like, to me, there's different skills. There's understanding product. That's a huge thing. There's understanding uh, like uh, like trends and consumer psychology of like where's the world going. That's another one. And again, that's why those are two pieces. There's the valuation side, which is much more numbers, and I think that part can be much more automated. Now, obviously, you should put your own spin on those numbers, because a computer can say, oh, analysts think it's going to grow at 20%. Maybe you have a different theory. I think it's actually going to grow quicker than that for X, Y, Z reasons. And that could be the case. Or you think that interest rates are going to go up, which is actually going to, lead to a lower price earnings multiple in the future, which is so you don't think it's as valuable. Like, you could have your own thesis, and I basically alter the existing numbers with my own thesis, and I make changes. But I try to start from that as a baseline. So again, do I understand the product? Do I understand trends? Do I understand the valuation, which is the most analytical? And then there's the last one, which is just like, how do I construct a portfolio? Which is like, how do these different pieces go together? You can have 5 great companies, but maybe those great companies are all correlated and they all have the same risk. And that company is probably going to be less robust than 5 other great companies that are not as correlated and actually work better together. And if one does poorly, the other does well. And so you're going to see less volatility. You're going to have more opportunity to sell one and buy another if you want to. And you're going to see better returns in the long run and probably less emotional um, stress. If your market goes, if you're, again, there's, if in 20 years all of them went up like 100%, you, in theory, you shouldn't care, but lots of people will get spooked when they see their portfolio go down 20%. So if you can smooth that out and say, oh, it doesn't go down, never goes up 50% of a month in a year, but it also never goes down 20%, and everything's kind of more muted. If the end goal is the same, it's probably better to have less volatility in your portfolio. Now again, that's in your portfolio. Individual stocks, I actually am in favor of big volatility, and the reason is volatility is an opportunity, especially when it's to the downside. When stocks go down 20% in a day, and if you still believe in that company and the thesis hasn't changed, it's on a discount. Why wouldn't you buy it if you still really believe in it? So, I've been buying the last little bit, but again, this is what's been going through my brain the last week is, hey, what do I want to buy? Do I want to double down on some stocks? And I have doubled down on some stocks because some of the stocks that I bought that were previously way too expensive now seem to be on sale, and so I'm looking to buy them. But I also want to say, how do they fit in with the broader portfolio? And are there new um, companies that I can add to the portfolio? In general, when there's a market crash, I typically look at existing ones because I already understand them so well. I've already done the research, and so I know what price they should be at instead of looking for new ones. When the market's flat or even up, that's when I typically do more research into new companies. I always try to do some, but it's harder, and so I'm more motivated when the market's up because if I invested in uh, Tesla and it's up, double where I expected it to be right now, then I'm not going to buy more Tesla. So I need to find somewhere else for new opportunities. So again, when stocks are up, typically I do more research into new companies, and when stocks are down, I typically consolidate into my highest conviction ones, and I think that's a good strategy to have in general. So hope this was helpful. This is a bit about how I do um, my investment research. So let me know what your process is. Would love to hear, as well as if you have any stocks you think I should be looking at to buy. So let me know in the comment section below. Thanks so much for watching, and talk to you next time.